Hi everyone, it's Josh here with the Solar Engine. Wanted to talk to you today about 4 common types of commercial solar financing that are out there, typically under the $300,000 range, which is about 150 kilowatts. Full disclosure, I am not a CPA, a tax professional, anything special like this. Us here at SolarGen, we are a solar distributor. We just want to help you put more glass on the roof. So please do not take this as tax advice. If you are a customer looking into different types of financing, same thing applies to you. But for our installer friends, make sure to encourage your customers to talk to their accountant, tax professional, etc., to make sure this will be a good fit for them. So yeah, let's get started. All right, so let's talk about debt financing. This is a financing method most of us are already familiar with. It's a loan. There's a term, a rate, and thus a payment. So this will be a method used for building owners who have the ability to and want to take on the tax incentives that come with owning a system. Because owning a commercial system comes with a traditional tax credit that homeowners get, which is currently 26% through the end of 2022. And on top of that, here's where things get interesting. The system is an asset that you can take depreciation on, and not just any depreciation, but accelerated depreciation under the federal Modified Accelerated Cost Recovery System. It's called MACRS for short, where the solar system's lifetime depreciation can be squeezed into the first 5 years of the system in its service. So that's a big boost in improving the payback period on this clean investment. And currently, there's a ping pong match going on with another tax incentive. It's called bonus depreciation. Currently, like right now, this very moment, it allows businesses to take 100% of that depreciation in the first year, but it's for qualified properties only. That is an incredibly important piece of wording there in the tax verbiage. So again, talk to a tax pro. They'll see if that property qualifies for the bank. Another popular option is property assessed clean energy. It's a PACE loan for short. The key difference here is that the loan stays with the property and not with the business itself. And other energy upgrades are encouraged to be wrapped into this style of financing. And the best part is all of the other tax incentives that I mentioned earlier are totally eligible to be retained for the person financing the project. So that's a lot to take in. And again, tax professionals will make this a lot easier for businesses. For you though, to sell the project, there might be an easier way, especially if the building owner already knows they don't qualify for all that tax jazz. So stay tuned for 3 more options we're going to talk about outside of ownership. All right, so we're going to talk about third-party ownership. This is where the user of the energy doesn't actually own the system. They didn't want to mess with the taxes, they couldn't qualify for them, etc. So first one here it's called a PPA. It's a power purchase agreement. It's a simple way for properties to go solar without worrying about being able to absorb those taxes. It's straightforward, not only for going solar, but also ensuring that the system operates to its maximum capability, because typically in those PPA contracts, there's sort of a service agreement baked into it, because at the end of the day, the lender or whoever's, recouping the investment by charging for the kilowatt hours, they want to make sure the system's producing to the most it can, therefore they get paid more. So the user of the energy, so the building itself, they're called the off-taker. That's just the terminology for it. They pay for the energy produced by the energy of the system on a per kilowatt hour basis for a set period of time. It's usually around 10 to 20 years. And that payment is based on the amount of energy the system produces. As I mentioned earlier, that's why it's important for it to produce to its best ability. That same reason though, or not same reason, but under that same, thing is that that payment's going to change every month, because if it's the payment's based on the production, some months it's better, some months it's lower. We know how winter and summer works in solar, so that's how that's structured. So the investor, on the other hand, they own the system. They take all the benefits for the taxes and ideally pass some of those savings on to the off-taker. And here's where it's a little bit interesting. In those agreements, in order to alter the savings and the investment benefits of each side, there's what's called an escalator in there, baked into it, where the contract, the kilowatt hour price increases every single year by a percentage. And this can work to the benefit of either side. So a higher escalation could mean a lower per kilowatt hour price earlier on to provide better savings to the off-taker, and more returns for the investor later on in the contract as that escalation rises. So it's a great tool to help create a win-win scenario, but you also need to evaluate it in conjunction with the price of energy there locally from the utility. You don't want to make it so crazy and hard to grasp and attain, I guess, to where the energy prices outpace the utility rates. Then what's the point of having it in the first place? So it's a tool, but with a great tool comes great responsibility to make sure it's in line. So that's a PPA in a nutshell. All right, so the second third-party ownership type of finance that we're going to talk about is the lease. Leases are so similar to PPAs, they often get confused with one another. And for good reason, they are similar. The end user of the energy from the solar system doesn't own the system itself. In either case, an investor or bank does, so they can get the tax benefits and other incentives for owning the system. Sounds familiar, right? So term lengths and rate escalators are also strikingly similar between the two. So let's talk about how they're different. Few differences. Lease payments are the same every month. This contrasts to PPAs, where it fluctuates based on how much the system produced and is thus owed to the PPA provider. Leases are also more likely to be structured to allow for a takeover of ownership later on down the road. You can also prepay a lease to lower the monthly payments. Then with leases, there's a couple different types, but let's talk about two briefly. There's the capital lease. So that shows up on the balance sheet of the company. Or in an operating lease, it would be off the balance sheet. And there's pros and cons to each one. I'm not going to pretend to be a tax professional and understand how that might work out. So of course, someone needs to talk up to their tax professional in considering those. And the benefits can be wildly different depending on the business models. But that is a lease in a nutshell, similar to a PPA with a few key differences. All right, so we're going to talk about a third type of third-party ownership. This one is called tax equity financing. And this type of financing is typically used for much larger projects. Green Tech Media reported back in October that investors won't touch projects below $50 million for this type of investment. It just doesn't whet their appetite. Imagine how much you owe Uncle Sam if you won't touch anything below $50 million. That's something. But I'll still break it down, the basics at least, for the sake of understanding what's out there. Plus, things might change in the future, so it's worth having that basic knowledge. Like the other two, it's similar to a lease or PPA. Tax equity financing requires an investor with a large enough tax liability to absorb those benefits. So a key difference here, though, is that solar developers get involved. They're the ones that don't have the taxable appetite to take on that much tax credit. So this is where the investors come in. They usually put in about 40% of the project costs, and that gives enough, after 5 to 7 years for them to get a decent return, which industry standard seems to be around 15% internal rate of return. But before this whole process begins, the developer and investor come to an agreement to figure out how to handle the ownership of the project. There's 3 main types. There's the partnership flip, sale leaseback, and the inverted lease. For the sake of the short video, I'm not going to cover those. Just know that they exist as options for both partners to profit from the project and find win-win scenarios. All right, so that should cover the basics of these common commercial financing methods. Hope you're able to find some takeaways today for yourself. And if you're working on a commercial project that you need help finding reliable financing, I want to hear from you. So fill out the quick form in the link to this email, and let's see if we have some overlapping interests. I'd be happy to help. So talk to you soon.